Hey everyone, welcome back. Today we're chasing those high-yield dividends, and I found an article that's got me intrigued, to say the least. It claims you can rake in $100 a year in dividends alone with just a $4,450 investment. $100 just for owning a slice of the right companies. Let's break it down with our expert and see if this holds water. You ready?
I'm always ready to talk dividends, but, it's one thing to chase those high yields and another to find ones that'll last. That's the real challenge, isn't it? And that's what we're here to uncover today.
Music to my ears. Now, this article jumps right in, no time wasted, and throws out some familiar names. We've got AT&T, the telecom giant. They've always been a dividend darling, but they've been making some interesting moves lately. Then there's PennantPark Floating Rate Capital. Now, that one might be a mouthful, I know, but the article calls it a BDC, and honestly, I'm drawing a blank here.
Ugh. A BDC, that stands for Business Development Company. They're kind of like financial matchmakers, if you will. They provide loans to mid-sized companies, those companies that are on their way to becoming household names. Those businesses need capital to grow, and that's where BDCs come in.
So instead of investing in those companies directly, you're investing in the company that's lending them money and getting a cut of the interest payments as your dividend.
Exactly. You're basically providing the fuel for those businesses to grow.
Okay, I'm starting to see the appeal. So that's AT&T and this BDC, PennantPark. What's the third company in this high-yield lineup?
The third one is W.P. Carey, a REIT or real estate investment trust. You might have heard of REITs before. They own and manage properties that generate income, shopping malls, apartments, office buildings, that sort of thing.
Right, REITs. I've heard of those.
Hmm.
But this article mentioned they've been shaking things up lately, something about ditching their office buildings. Who walks away from office buildings these days? It seems counterintuitive.
You're telling me. But it all comes down to strategy. They're shifting their focus to other types of real estate that they believe will be more profitable in the long term. We'll dive into the specifics later, but the key is they're not just reacting to the market, they're staying ahead of the curve.
I always appreciate a proactive approach, especially when it comes to my investments. Okay, so we've got our three contenders, AT&T, potentially returning to its dividend glory days. Then there's PennantPark, aiming for those high-yield returns by lending to growing businesses. And finally, W.P. Carey, our real estate maverick, shaking things up in a big way. Let's break it down, starting with AT&T. This article mentions they've been selling off parts of their business. What's the strategy there?
Streamlining. Remember that whole Warner Media merger and then the spinoff? They're essentially getting out of the media and entertainment business. AT&T is going all in on telecommunications, specifically 5G and fiber optic infrastructure, the backbone of our increasingly connected world, you could say.
So they're betting on the future of the internet. Seems like a safe bet these days, everyone, and their grandma is online.
Exactly. And 5G isn't just an upgrade, it's a game changer. It's about connecting everything, our phones, our cars, even our refrigerators. And all that data needs to go somewhere, which is where AT&T's infrastructure comes in.
More data, more demand for their services, more revenue for them. But how does that translate into more dividends for investors?
Well, that's the million-dollar question, right? 5G is expected to lead to a massive surge in data consumption, which could mean much higher demand for AT&T's services. More demand equals more revenue and potentially higher profits, which gives them more room to increase those dividend payouts.
It all makes sense. They're streamlining their business, focusing on a high-growth area, and potentially setting themselves up for some serious dividend growth. Okay, AT&T, check. Now let's move on to PennantPark, our BDC, with that impressive yield. The article mentions it's at a whopping 10.45%. I mean, wow. But why would they offer a rate that's so much higher than, say, a traditional bank?
That's the thing about BDCs, and why they can be so appealing to income-focused investors. They often invest in companies that are considered a bit riskier than, those blue-chip giants you might find in the S&P 500. Remember, we're talking about mid-sized companies, those still trying to make a name for themselves. And because these loans carry a bit more risk, BDCs often offer higher interest rates to compensate investors for that risk. It's all about balancing risk and potential reward.
Higher risk, higher reward. I've heard that before. But what kind of risks are we talking about here? Give me an example.
Imagine they lend money to a promising tech startup developing some cutting-edge software. Now, this company might have incredible potential, but they might not have a long track record of profitability. That makes them a riskier bet than, say, a well-established company like Apple or Microsoft.
So there's a higher chance that tech startup might not be able to repay its loans, which wouldn't be good news for PennantPark or their investors.
Okay, that makes sense. But what about W.P. Carey? They're a REIT, but they're in a totally different game than PennantPark. They're all about real estate, not lending. And yet, they're also known for those high yields. How does that work?
It's a different approach, sure, but both aim to deliver those juicy dividends we all love. Remember W.P. Carey ditching their office buildings? Well, they're not just getting out of offices. They're putting their money on other types of real estate warehouses, industrial properties, that sort of thing. And it makes sense when you think about it. E-commerce is booming, right? All those online orders need somewhere to go, and that's where warehouses come in. W.P. Carey is basically positioning themselves to ride that wave.
Okay, so they're tapping into the e-commerce boom. Got it. But what about those net leases the article mentioned? How do those fit into all of this? Good question. Net leases are actually key to understanding how W.P. Carey can offer those consistent dividends. Imagine you're a business owner and you're renting a property from W.P. Carey. With the net lease, you, the tenant, would be responsible for a lot of the operating expenses, things like property taxes, insurance, even maintenance. This setup takes a lot of the burden off of W.P. Carey, and it creates a more predictable income stream for them.
So less hands-on for W.P. Carey and more stable income for them. I'm starting to see why this net lease thing is a big deal. But for us regular investors, what's the main takeaway here?
The main takeaway is that net leases can make W.P. Carey's income more predictable, which good news for those dividends. Consistent income means a higher chance of consistent dividends and potentially even growing dividends over time. It's all about finding those companies with strategies that support long-term dividend payments. And W.P. Carey's shift towards net leases and in-demand real estate seems to be doing just that.
Love to hear it. Consistent and growing dividends are music to my ears. Okay, we've covered a lot of ground here. We've got AT&T betting on the future of connectivity, PennantPark riding the wave of high-yield lending, and W.P. Carey making some savvy real estate moves. But let's bring it all back to that intriguing claim from the article. Can you really earn $100 in annual dividend income from a $1,450 investment? Is that really possible?
Well, if you look at the current yields of these three companies, the math does seem to add up. But remember, investing always has a but, right? Past performance is not always a guarantee of future results.
Words to live by. Just because a company has paid a certain dividend in the past doesn't mean they're obligated to keep doing it in the future. They could cut the dividend or even get rid of it completely. So what are some red flags investors should be on the lookout for? What should we watch out for?
You got it. It all boils down to due diligence. Don't just blindly chase the highest yields without doing your homework. Look beyond the numbers and consider things like the company's financial health. How much debt do they have? And what about their overall business strategy? Do they have a clear plan for growth? These are all crucial questions to ask before investing your hard-earned money.
So it's not as simple as just, picking the stock with the juiciest yield and calling it a day.
If it were only that easy, we'd all be sipping cocktails on a beach somewhere, living off our passive income.
Wouldn't that be nice?
Yeah.
But in the real world, what are some key things to keep in mind when you're building a dividend portfolio?
Well, for starters, always remember those dividends aren't guaranteed. They're decided by the company's board of directors. Past performance can give you some clues, but it's not a crystal ball, right?
Right. Don't get blinded by those tempting yields. What else?
Diversification, diversification, diversification. Never put all your eggs in one basket. Spread your investments across different companies, different industries even, to help manage that risk.
That's solid advice no matter what kind of investing you're doing.
Absolutely. Now, one more thing I want to throw out there, the magic of dividend reinvestment. This is where things get really exciting. Imagine taking those dividends you're getting and automatically reinvesting them back into the same companies that paid them. You're basically using your dividends to buy even more shares, which then create even more dividends, and so on.
Wait, so it's like a snowball effect. Your money makes money, and then that money makes more money.
Exactly. It's the beauty of compounding in action. By reinvesting those dividends, you're letting your money work for you, helping it grow exponentially over time.
This has been amazing. We've gone from high-yield hopefuls to savvy dividend investors in just one deep dive. So any final words of wisdom for our listeners before we wrap up?
Remember, when it comes to high-yield dividends, don't be afraid to explore those opportunities, but always, always do your homework. Understand the company, the financials, their strategy, the whole 9 yards. Second, diversification is your best friend. Spread those investments around. And finally, that dividend reinvestment, it might seem like a small thing, but over time, it can make a world of difference.
Fantastic advice. Knowledge is power, especially when it comes to investing. Thanks for joining us on this deep dive. We'll see you next time for another exciting exploration of the financial world.